Hello, this is Leah with your weekly grain market update for the week of June 5th. Corn futures were down 7 cents for the week. The corn market traded lower for the sixth straight session to wrap up the week. From a technical standpoint, the market is very oversold at this point and may be due for a bounce. From a fundamental standpoint, traders have sent front-month futures back to levels seen in the early fall of 2025. Essentially eliminating any and all risk premium built through 2026 on factors such as the Middle East war, record demand, and a dry pollinating window for parts of Brazil. Fresh news was scarce on Friday within the corn market, which at this point is part of the issue, with nothing to reassure formerly bullish traders and halt the rapid sell-off of long positions through 2026. Although it seems likely USDA is underestimating export demand in the balance sheet, I remain skeptical of other demand categories such as feed, residual, and ethanol. At this point, it is hard to see U.S. corn reserves falling below the 2 billion bushel mark by the end of August. With comfortable old crop reserves and weather thus far offering few early clues to a production shortfall for the upcoming harvest, traders quickly lost confidence through the month of May in what was the largest net long position in over a year. The question from here is how bearish traders have become, as it is also difficult to picture a desire amongst traders to carry a short position from early June with all of July's pivotal weather still ahead. In world news, the situation continues to lean bearish as harvest pressure will begin to set in on world values, with Argentina over 40% complete and Brazil just getting underway in terms of harvesting their crop. Both are expected to be very strong crops, with Argentina's predicted to be a record and potentially north of 60 million metric tons. Soybean futures were down 8 cents for the week. Mild export demand combined with good growing season weather are the major fundamental factors pressuring prices. From a technical standpoint, July futures are very oversold, but traders appear to challenge early 2026 price levels, with the sharp rally beginning in early February, leaving few clear support levels. Through the last few weeks, even as weather factors and export demand began to lean bearish, soybean futures have remained supported by absolutely incredible crush margins. However, through this week, product values have also begun to turn, and while the July board crush premium remains historically high, the pressure has accelerated selling in the soybean market. Traders will continue to watch closely for signs of Chinese demand, with no official labeled purchases on the books as of the end of May, and the White House stating that a 25 million metric ton volume was agreed upon in trade meetings in October and May. However, it is important to remember that grain buyers are economically savvy and, like speculators, are likely betting on lower prices to come. Brazilian offers remaining a discount to the U.S. and with plenty of volume available is of course another factor to play. Wheat futures were down 1 cent for the week. Wheat news was very slim on Friday, with the issues of the upcoming winter crop in the U.S. well known and priced in at this point. Despite what is expected to be a historically poor U.S. crop, traders are showing few concerns for world wheat supplies at least over the next 6 or so months. Reports this week of excessive rain in China and a decline in wheat quality have traders optimistic that U.S. wheat could benefit from increased demand, especially with the White House claim that China agreed to buy $17 billion in non-soybean USA products. It will be a situation to monitor with deferred production in the southern hemisphere in late 2026, early 2027, expected to be much lower than the past cycle. Just some things to think about. Reach out to your local grain merchandiser with any thoughts or questions. Hope you had a fun and safe weekend.